They didn't just crash silver by accident. What you saw was not random, not natural, and definitely not just the market doing its thing. What happened to silver was intentional, calculated, and perfectly timed. And if you still watching silver prices without understanding what's really happening behind the scenes, you're already at a disadvantage. Silver was running hot, momentum was building, retail interest was growing, headlines were turning bullish, and then suddenly, within a very short window, the price collapsed hard. Confidence vanished, fear took over, weak hands rushed for the exit. That's not how a healthy market corrects. That's how a trap is triggered. This is where most people get it wrong. They think markets move only because of supply and demand. In reality, short-term price moves are often driven by leverage, paper contracts, and forced liquidations. Silver is one of the most heavily manipulated markets on the planet, not because it's weak, but because it's strategically important. Before we go deeper, if you value clear market breakdowns without hype, make sure you like this video and subscribe to Past and Profit. It helps the channel, and it ensures you don't miss what's coming next, especially in markets that are designed to confuse retail investors. Now here's what actually happened. Silver didn't collapse because people stopped needing it. Industrial demand didn't vanish overnight. Solar panels didn't stop being built. EV production didn't pause. Electronics didn't disappear. What changed was positioning in the paper market. Futures contracts piled up, leverage increased. And when the moment was right, price was pushed down fast enough to trigger margin calls. When margin calls hit, traders are forced to sell regardless of logic. That selling pushes price lower, which triggers more margin calls. It's a cascade, and once it starts, it feeds on itself. This is why silver crashes always look violent and emotional. They're designed to be. The key thing most people miss is this. While paper silver was crashing, physical silver was quietly being pulled out of vaults. Inventory levels didn't surge, they dropped. That's a massive disconnect. If silver was truly unwanted, physical supply would pile up. Instead, it keeps leaving the system. This exact pattern has happened before. In 2008, silver collapsed alongside everything else, only to explode higher in the years that followed. In 2011, after a massive run, silver was smashed down with rule changes and margin hikes, right when retail participation peaked. In 2020, silver crashed with the market, then doubled in a short time as reality caught up. Each time, the same playbook was used: build excitement, allow leverage to grow, trigger fear, flush out weak hands, accumulate quietly. The reason silver matters so much is because it sits at the intersection of money and industry. Gold can be hoarded, Bitcoin can be coated, but silver is consumed, it gets used up, and replacing it is not easy. Most silver is mined as a byproduct. You can't just turn on more supply because prices drop or rise. At the same time, governments are pushing massive energy transitions. Solar panels require silver, EVs require silver, data centers, AI infrastructure, and military tech all rely on silver. Demand is structural, not optional. So when you see silver crash while long-term demand keeps rising, you have to ask a hard question. Who benefits from lower prices? Big institutions do. Sovereign buyers do. Industrial users do. They get to lock in supply cheaply while retail investors panic and sell. This is where emotion becomes the real weapon. Fear makes people forget why they invested in the first place. Fear makes people sell at the worst possible time. And fear spreads faster than facts. If you're holding silver, the most important thing right now is clarity. Why did you buy it? If it was for quick profits, volatility will shake you out. If it was for long-term protection against inflation, currency debasement, or systemic risk, then a paper-driven crash changes nothing fundamental. Another thing that matters is what kind of silver you're holding. Physical silver and paper silver are not the same asset, even if they share the same price chart. Paper silver can be created in unlimited quantities. Physical silver cannot. Under stress, that difference becomes very real. At Past and Profit, we always say markets don't move to reward the most people. They move to expose the most people. Silver is exposing who understands volatility and who doesn't. And here's the part most people don't want to hear. These crashes are not designed to end the silver story. They're designed to reset it, to make sure participation is thin before the next move begins. That next move doesn't need to happen tomorrow. It doesn't need to happen next week. Markets can stay frustrating longer than most people expect. Sideways movement is often used to drain patience after fear has already done its job. But when silver finally moves, it tends to move when confidence is lowest and attention is gone. That's how markets surprise the most people. So instead of asking where silver goes next week, a better question is this: are you reacting emotionally to price, or are you aligned with the long-term reality of the asset? If this breakdown helped you see silver from a different angle, let me know in the comments how you're thinking about silver right now. Share this video with someone who's confused or frustrated, because understanding spreads faster than panic. And make sure you're subscribed to Past and Profit, because silver's story isn't finished. In many ways, this is exactly how the next chapter begins.